and
Oh, okay.
we'll tell the full story because we are officially live on Facebook for the Not Your Average Investor Show Thursday edition, where we do the JWB Property of the Week.
Week.
I'm your host, Pablo Gonzalez. With me, as always, is the guy that they call GC because he's just gonna care more than everybody else, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Good to be with you. Good to be with you, Pablo. I haven't seen you in a while, buddy.
I know, right? We've only seen each other like 3 times today, which is awesome. And hello, John Henning. Hello, Rami Kara. Nice to have you here in the chat with us. And I love that you are already using the chat function, which is part of my daily housekeeping, right? When you want to communicate with us, which we hope that you do, because today's Thursday shows is really about you. We want questions early and often as we are analyzing this property so that we can really answer any questions you may have about the business model, about the property itself, about what your friend told you about rental property investing, what your friend told you about Jacksonville, what you saw on The Good Place, whatever you want to say, whatever you want to say. But the 2 ways to do it is what people are doing right now, using that chat function that's on the bottom left. Hello, Rick. How are you? Good to see you. Little caveat on that chat button, right? Like Rami and Rick, if you look at where you type in your question or you type in your comment, right above that, it says panelists. If you hit that button and drop it down to all panelists and attendees, now everybody gets to talk with each other, and we all get to see your comments that you're making. And I want that for you, right? I want you all to be able to communicate with each other and maybe make a new friend. And if you definitely want your question answered on the show, there you go, Rick, fast learner. Thank you. If you want your question answered on the show, for sure, go to the Q&A box on the bottom right, click that and put your question in there. The reason I say that is not because I'm not reading the chat. I am reading the chat, but that tends to move really quickly while the Q&A stays there. So guess who's here, Greg? Guess who?
Jay Cargrove. He's in the house.
In the house. Go to the Q&A thing so that it doesn't go away from my attention, right? Like there's a lot going on right now. I'm trying to keep track of the chat. I got the Q&A. Greg's dropping brilliant nuggets of wisdom that I try to have it shower over me and make me wise as well. So if you don't want me to go cross-eyed, use that question and answer. And welcome everybody that's watching on Facebook Live as well. And apart from that, Greg, where do they go if they really just want a soup to nuts breakdown of what property investing is like with JWB? Where is that, my friend?
Come hang out with me for about an hour. I put a web class together. It's at jwbwebclass.com. Come on, hang out. You'll enjoy it.
That's right. So not only do you get to hang out more with Greg in perpetuity, but you also get the free investor toolkit, which part of that is this document that we're going to be using today to break down the property, which you can download, you can use to analyze any property that to your heart's content, whether it's a JWB or not. They've done the work for you. They've created that Excel sheet so you can really get all the costs on whatever you're looking at. So without further ado, Greg, you said you had a story about this property we're about to talk about, 8950 Sibbald Road, Jacksonville, Florida, 32208 for all you zip code junkies that know where the good properties are at. I'm going to pop it on here. Greg, you want to talk about it?
Let's do it, man. Let's do it. In fact, as I'm telling the story, I wish I had thought a little bit more about this ahead of time because I have a great picture I could show that could really highlight this story. But has anybody out there seen one of those like big like moving trucks that is like painted with some obscene advertising on it? Have you guys seen that out there, right? Probably. Have you ever seen that, right?
Yeah, of course.
You're just thinking like some young startup company has, very limited marketing budget, but you know what? Somehow they bought like a $2,000 beater moving truck off, eBay or whatever, and then they just painted it. Well, that's one of the things that we did when we started JWB. One of the very first things we ever did, one of my very first marketing campaigns, was we bought an old moving truck, a box truck, like an old U-Haul. And we bought it. I don't know what we paid, probably $2,000 for it. The thing did run, but not very well. And so we used that thing. We bought that thing, and then we got it painted on the side, and it said, "We buy houses," in the brightest yellow and black, most, eye-opening colors you could see. Mm-hmm. "We buy houses," our phone number on it. And my plan was to park it in a highly trafficked area, and that was going to generate leads for us so that we could acquire undervalued properties. So then we could do what we do for rental properties. And it worked. You want to know how many times it worked, Pablo?
How many?
One. The property on Sibald is the one time that it worked. It actually created an incredible amount of stress because I had to figure out where I could park it, and the city doesn't allow you to park those things in highly trafficked areas. But what it did is it allowed me to buy one of my very first rental properties on Sibald Road. It happens to be almost next door to this property that I'm going to show you here at 8950 Sibald Road, which is the property of the week here for JWB. It's currently available. And I'm going to tell you a little bit about why I love it for you, for your rental property portfolio. And then for those of you who are not in a position to invest yet, use this time as a trial run. Use this time, this experience, ask great questions, because you want to put yourself in the hot seat before you get there, right? Get yourself prepared before you pull the trigger on your first rental property investing, and use this as that trial run.
Perfect, Greg. So I'm going to, for those of you that are watching us on video, fantastic. We love having you here, but little secret is that we repurpose this stuff into a podcast so you can listen to later. So I'm going to be reading out some of these numbers so that our podcast listener, thank you, who has us in your ear right now, someday in the future, knows what we're talking about here, right? So we're looking at this property. It looks like a, what is it? A 3-bedroom, 2-bathroom house with a 1-car garage, selling at $148,000. When we look at the estimated conventional financing total return on investment, it's at 9.31%. It has a total monthly cash flow of $214. And what's another good number? The estimated rent range, right? I think you fancy real estate investor types like the rent to price ratio. It's estimated at 1,025 to 1,075. So Greg, first, for the first-time comer that's joining us today, tell me about this cash flow number of $214. What does that include? What does that not include? So that we're all talking apples to apples here.
Absolutely. So we want to understand what is the net cash flow that is coming to you on a normal month. That means you take the rental income that comes to you and you subtract the normal expenses. Your normal expenses that happen every single month would be your principal and interest payments, your property taxes, your insurance costs, and then your monthly property management fees. That's what happens on a normal month. So if you take all of that, the net amount of that is going to be slightly over $200, which is where you want to be, especially for a low priced property here. This is on the bottom end of the threshold for JWB. Over $200 is where you want to be for your net monthly cash flow.
Great. So you're saying this is the bottom end of the price range, 148,000. Do you want to kind of just like explain that a little bit further, what the usual price range and whatnot?
Yeah, absolutely. So in Jacksonville, the market is bearing right now between about $150,000 to $210,000 for your purchase prices. And those are for cash flow neighborhoods. That's the only place I'm going to put you if you're a JWB client, or the only place that you should be investing if you want to be a successful rental property investor, right? You have to invest in below middle income neighborhoods. And that's what this neighborhood is. It needs to be cash flow positive. It needs to be surrounded by jobs. And it needs to be a place where professional property management like JWB wants to manage your property and has significant experience getting long-term resident stays. And so to do that, the price points in Jacksonville are about 150 to 210. Your renovated homes are going to be largely between about 150,000 to 180,000 for your price points. And then your new construction houses will be between 180 and 210,000 largely as far as price points.
Makes sense. And as I look at this picture here, normally when I see a house that's a new construction home, right, not just price point is telling me that this is a renovated home, right? Like when I see usual new construction homes, they look a little bit different than this, but this still has the, classic JWB curb appeal here. And I want to give it up right now. Candace Morrow coming in with our first question of the day. I love it, Candace. We love the questions early and often. She says, if I pay cash for this property, what are my returns?
Well, that's a great question, Candace. So, and Pablo, I'm glad you're focusing right there. So when we think about returns, we're going to think about the things that happen that we have a high degree of control over. especially in the short run. And that's what you're going to see reflected on this property valuation. So for those who aren't listening or aren't able to look at it, for your cash purchase returns, they're estimated at 5.48% for a cash purchase. Now that takes into account your profit centers of your net monthly cash flow, your tax savings, but it does not take into account your principal pay down because you don't have a loan, and it doesn't take into account your home price appreciation. So if we're just looking at what we have a high degree of control over in the short run, like your first year, you're looking at about a 5.5% return. If we start to include, if you are the type of investor who is buying for a full market cycle, that's when you can start to count on home price appreciation, because historically home price appreciation comes back to the norm over a full market cycle. That is a little bit over 4% appreciation. So if you want to look at all of the profit centers for a cash purchase, if you are investing for a full market cycle, which is known to be between 10 to 20 years, you're looking at, there you go, Pablo, 9.74% for all profit centers for a cash purchase.
Let's stay here and talk about that appreciation thing, right? So it went from, I'm just gonna say it out loud for our friend that's listening on a podcast, right? But the original conventional financing return on investment, well, so the cash flow, the cash purchase return on investment, when we put in the appreciation, goes from 5.48 to 9.74. But the finance return on appreciation goes from 9.31% when we put in 4.3% appreciation to 24.94, almost 25%, Greg. So can you explain that so that we get everybody up to speed on that one?
Absolutely. This is one of the keys to creating a portfolio of rental properties, is learning how to effectively use debt, right? When you're using debt, a lot of really great things happen. One thing that happens is you get a better return on your investment just from the cash flows. So Pablo, if you wouldn't mind, go ahead and take that appreciation rate out of there. All right. If we drop that back down to zero, if we're just talking, this is really just talking about the cash flows now, your return on investment just from the cash flows for buying with cash, which means no debt, is about 5.5%. Right? If you're buying with conventional financing, which means you're taking on smart debt, your return on investment's 9.31%. So that's one great thing that happens with using smart, effective debt. Now, the next thing that happens, Pablo, if you wouldn't mind, go ahead and put 4.3% in for appreciation. Again, that is a historically accurate home price appreciation rate in Jacksonville. That goes all the way back since 1991. That's from the Federal Housing Finance Agency data. And if you're investing for a full market cycle, that's what you can count on, again, over time, a 10 to 20 year hold each year. Now, when I look at the effect of what appreciation does for a cash purchase and for a conventionally financed purchase, they're completely different. In the cash purchase, it goes up about 4%. It goes up 4.3%. In the conventionally financed purchase, it goes up way more than that. Right? It goes up about 16% or so. Okay. The reason is because when you are taking on debt, you're only putting down a fraction, right? Either 20% or 25%. But when you're experiencing home price appreciation, the value of the asset goes up that 4%, right? But your down payment's only 20 or 25% of it. And so what happens is in a growth market, the value of leverage is that much greater because it allows you to skyrocket your return on investment. And what we see here now is when you fully look at all profit centers, and the caveat is that you have to be investing for the long haul. But if you are, then you can look at this and say, this is really over a 20% return. Again, look, using all of the profit centers, investing for a full market cycle, that's the real picture. And you can do that with conventional financing.
And I just, I'd feel remiss to point out that the idea that Jacksonville is a growth market is one of your key differentiators at JWB, right? Like it's a reason why you come to Jacksonville versus a Cleveland or other cities that you like to poo-poo on.
Well, I only I only poo-poo on Cleveland because I'm a Pittsburgh Steelers fan. I mean, I have to. But yeah, I mean, I'm very candid about the fact that if you go to a market like Cleveland, your rent to price ratio, the cash flow numbers that you see, the returns just from the cash flow, they're going to be higher if you go to a market like Cleveland, right? But what we're going to miss out on is the compounding effects of home price appreciation over a 10-year hold or a 20-year hold. And when you look at all profit centers, when you look at the internal rate of return, the difference is mind-blowing between investing, let's say, $100,000 in Cleveland versus investing $100,000 in Jacksonville and watching that grow over a 10-year period. Yeah, your cash flows might be slightly higher in Cleveland than Jacksonville, but your growth is almost double in Jacksonville over what it will be in Cleveland using historically accurate numbers. So that's why I'm a big believer. You guys know I'm completely biased, but I'm a big believer that you need to be investing for the total picture, the total return, including all profit centers. And that's why I have all my rental properties in Jacksonville.
Great. And an awesome follow-up question here by Rick Margwin is how long is a full market cycle?
It's just generally known to be between 10 to 20 years. And so if you look back at different market cycles in Jacksonville, and you can do this in any market that you're in, what you're going to see is that the historically accurate home price appreciation rate tends to repeat itself in those same 10 to 20 year windows. An example of this in Jacksonville. So 4.3% is what we've done since 1991. And many people are still burned by what happened in the Great Recession from 2011 to 2000, or from 2007 to 2011. Pablo, do you remember how much the market dropped from 2007 to 2011 in Jacksonville?
Man, I don't know that number exactly. No.
Good. I'm glad I stumped you there. It doesn't happen very often these days. I relish this moment. The market in Jacksonville dropped over 35% from 2007 to 2011. Home prices dropped over 35%. Now, that's one data point. Now, there's another data point that a lot of people don't know, and it just reinforces this point that history repeats itself as far as home price appreciation rates repeating themselves over full market cycles. If you go back from 2001 to present day, and you take into account the great run-up from 2001 to 2006 of home prices, and then you take into account the great fall of home prices from 2007 to 2011, and then you've seen the subsequent rise, the average appreciation rate for that market cycle is 4%. So most people would be shocked to know that. They just assume it's been down, or maybe if they've only been investing for a few years, they think it's been up. But that's what real life is. That's why history repeats itself. And at the core of it, that's why you need to factor in growth and home price appreciation if you're a long-term buy and hold investor, or else you're focusing on, well, you're just missing the biggest component of your eventual returns, is the way I look at it.
That makes a lot of sense. And I feel like we have a lot of new people on this call today. So I just want to say you started in 2006, right? How have those properties performed?
Well, I'll tell you, in 2006, I was a newbie. And I read a book called Rich Dad, Poor Dad. And I totally understood the fundamentals of rental property investing. I had some great mentors along the way. And I went out and bought 40 rental properties in 2006. And it was me and a couple of my business partners who, we were like 23. We had all of the theory down. We didn't have a whole lot of the application down at that point. And I'm so thankful that I learned from the best of the best. Because in 2007, when things started to fall, I had some moments where I was like, this isn't so great. I was looking at my home values on paper, and I'm like, wow, I hope what they're saying about the market coming back really happens, because everybody else was running for the hills. Everybody else was selling their properties and all this other stuff. And I just believed in the market fundamentals that I had been taught, that real estate markets are cyclical and they're going to come back. And I coupled that with the same, overall goal for myself and for my business partners, which was to buy and hold for full market cycles or longer, right? This was going to be our retirement account, 10, 20, 30 years after I started to invest. And so what I realized is that the number one thing for me was positive cash flow. And even as the market was going down in 2007, 2008, 2010, my positive cash flow was still there, right? The rents were still coming in. The rents were still consistent. And then what I also realized is I didn't care at all about what my net worth was on paper during that time. It did zero for me. So when they told me that my property was worth this and now it's worth 30% less, that didn't affect my quality of life at all because I had this 10, 20, 30-year mindset. And so at some of the hardest points along the way, I just went back to the fundamentals. And the positive cash flow helped along the way. It helped to soothe that fear. And then now I still own all of those rental properties. I've not sold a single one of those first 40 that I bought in the height of the market in 2006. And just like that 2001 to 2020 cycle that I have shown you, right? The average appreciation actually comes back to the norm of 4%. That's what's happened with my rental properties. They went way down in value. They have gone back up, and it's my quality of life hasn't changed one bit because of what those home values have done. So I will tell you, there were some scary moments in the beginning when it was all theory. I hadn't actually done it. Now, after being through it, and of course, helping thousands of other investors make similar decisions to buy and hold for the long haul, it's like having the answers to a test ahead of time, right? Like it's in the stock market, you don't really know when things are going to go up or down or all that good stuff. You sort of know kind of over time it's going to work out, call it 7% or 8%. You have to be in for a long time. In real estate, it's a similar thing, except you get positive cash flow along the way. And you have all these other benefits like tax savings and principal pay down. But, as far as home price appreciation, as long as you have the long-term mindset, it's going to happen. Like it's going to come back to the norm.
Makes perfect sense, buddy. All right, so let's dive back into the sheet because Dave Gravina asks, how much do you budget annually for maintenance, insurance, and property tax?
Well, that's great. We've got those answers right there for you. Let's talk about taxes and insurance because that's the easiest one to see right there. Great job, Pablo. That's perfect. So what we're showing on the screen here is for estimated annual property taxes. That's at $1,992. So that's based on what the current property taxes are. And then we bump that up to account for the future sale, which is also going to increase your tax base for the year. So that's an estimate of what your taxes will be once this property is purchased. Homeowners insurance is actually quoted for you ahead of time. So that's our friends over at the Ritchie Insurance Group. We actually, and this is a great thing, this is very different than most turnkey providers. Many just put like an estimate out there, but we're so locked in with our insurance team that they get to see these assets before we actually sell them, before we would present them here. And they go ahead and they do the policy for that property specifically. And then for you during the closing process, you're introduced and then the quote is there for you. And all you have to do is say yes. And of course, we advise you to insure it the way that I do for my rental properties, and the Ritchie Insurance Group is there to answer any other questions there. But that's a real insurance number. That's an actual quote. So $425 is actually pretty low for a renovated home.
And maintenance rate, Greg, you want to talk about how you calculate that?
Yeah. So maintenance is another great thing. I'm glad there's questions about this because if we're thinking about how to help you buy the right turnkey rental properties, I want to point out where, others just kind of fudge the numbers and when there's real numbers. And so in the industry, you will hear other turnkey companies quote other rates for maintenance and vacancy cost. It might be, 5% for vacancy costs, and that's 5% of the gross rents that are collected for the year, is a common estimate. Another common estimate is 7% of the gross rents for the year is what your maintenance cost should be. Bobby, you know where they get these 5 and 7% numbers?
I do, Greg. You're now asking me something I finally know. You happen to have like 3,000 data points that you're able to get these numbers from.
Oh, you went ahead. You went ahead of the game. Okay. I was talking about the other guys though. What do the other guys do?
Oh, the other guys.
Yeah.
They read it in a book.
Yeah. They read it in a book. They make it up. They ask their friend who owns another turnkey rental company and they say, hey, what do you use? And they say, okay, cool. We're going to use that same number because nobody actually tracks it. No other provider that I'm aware of tracks their maintenance cost. But the biggest influence to you as far as your long-term maintenance cost is the quality of the renovation or the build and how effective your property management is as getting long-term resident stays. So just because their buddy used 5 and 7% and that's what they're going to use on their evaluations, you have no clue as to what their actual performance is. And the scary thing is neither do they, because they don't track it. As Pablo mentioned, we track it. So everything I'm going to put here is based in data as far as your vacancy rate and your maintenance rate. And an interesting thing here, we actually see a difference between maintenance rates for new construction and we see a difference for renovations. And because we have access to this data, we've been tracking this since 2011. We have every dollar in and every dollar out, over 2,000 properties that have been sold. We then look for other big things that can affect that maintenance number. Because the goal here is to set the right expectations with you as far as what your cash flow and your returns are, and then to hit them. Because if we do that, we perform for you, you're probably going to fill out the rest of your rental property portfolio with us. You're going to buy more properties with us. You're going to tell your friends and your family about it. So that maintenance percentage of 9%, Pablo, do you think that's higher? Does that ring a bell that that's a little bit higher than other maintenance percentages?
I did ring a bell there.
So that is a factor of whether that's a septic tank or that is on city sewer. All right. What we have established and what other people should also realize, but they don't always do it, is that you're going to have higher costs, higher maintenance costs if your property is on a septic tank. Now, does that mean that buying properties on a septic tank is bad? No. I love properties on a septic tank. I have a lot of them. But what you need to know is knowing that they're on a septic tank, what does that mean my maintenance cost is going to be? And then is it still a good deal based on the return on investment, factoring that in? So for us, we see 9% based on a renovated home being on a septic tank. And then what we look at and say, knowing that we have an increased maintenance cost here, can we still deliver over 9% returns on investment just from the cash flows? And we can. So Pablo, if you want to take that 4.3% appreciation rate out of there, drop that down to 0. Knowing that you have a 9% buffer now for maintenance cost, that extra maintenance cost is fully calculated into your returns here, we're still able to perform over 9.3%. And that's how we do that.
Beautiful, man. And while you were talking, I showed that the septic is actually on the evaluation, right? Like that says if it's sewer or septic, so that you are taking that into account. And right in line, we got Jeff Baker. Jeff, I have a friend who's called Jeff Baker that we used to call Jeff Baker Touchdown Maker. So that's how I'm going to say your name, if that's okay with you. Jeff Baker Touchdown Maker asks, are vacancy and maintenance costs included in your cash flow number? Now, you said that the maintenance is included in the cash flow number, but you want to talk about a little bit about the vacancy cost?
Well, let me clarify that a little bit. And we can actually run through this. And this is a great thing. If you guys haven't signed up for the web class yet, you get this property evaluation so that you can make these sort of adjustments just like Pablo and I are doing. Again, you can go to jwbwebclass.com. It's really cool. So let's answer Jeff Baker Touchdown Maker's question here. When I was talking about a normal month, right? You don't get maintenance and vacancy costs on a normal month. So that $214 does not count those expenses. Maintenance cost is not counted. Vacancy cost is not counted. It also does not include other benefits that don't happen on a normal month in your bank account, right? Other benefits would be tax savings. Those technically happen all the time, but it doesn't hit your bank account. And principal pay down. That happens as well, but it doesn't hit your bank account. So that $214 in a normal month, that's what's hitting Jeff Baker Touchdown Maker's bank account right there. So it does not include estimated maintenance and vacancy costs. Your estimated maintenance and vacancy costs show up in that total return on investment number. And we can kind of test this out. And this would be a cool thing too. You know, Pablo, let's just say that we were like everybody else and we wanted to juice our returns to be as high as possible. And we didn't really have any idea of what our maintenance costs were going to be. And we put 7% in for maintenance rate. Look what it's going to do to the return on investment, right? It juiced it, right? That is it. If I put 7% there, 0 investors would ever question me, right? I would get 0 questions because that's sort of like an industry standard across the board of all types of properties, new construction, renovations, whatnot. Right? So what happens is it doesn't affect the monthly cash flow number because that's not a normal month of hitting your bank account, but it does, the maintenance cost does, and the vacancy costs do account for the total return on investment. It also takes into account your tenant placement fee as well. It also takes into account those other profit centers of tax savings, principal pay down, and that's how we ultimately get over that 9% return there. Great question.
Nailed it, buddy. And I really like how you embraced Jeff Baker, touchdown maker's name there. That really
that's a Gator thing, right? That's Dallas Baker, touchdown maker from the 2006 Gators, right?
This guy, Jeff Baker, is a guy I met networking a couple years ago here. He was a marketing guy that figured out this like amazing back end A/B process, and his company called him Jeff Baker, touchdown maker. So, okay. But yeah, I think Baker and touchdown maker. Anyways, I think we're derailing the show here. Speaking of derailing the show, I'm going to take a break right now. We have a bunch of amazing questions. Thank you so much, everybody, for putting in these questions. Really, really good stuff that I want to get through. But we also have this Facebook group that we interact with our with our community in between calls. You can find it at, I'll put it in the chat here, jwbfacebookgroup.com. It's got over 1,700 real estate investors in there that you can network with. You can verify whether everything Gregg is telling you is true or not, how, whatever you want for that, right? But you can up your knowledge, up your networking skills. And we got a couple questions from the group that I wanna get out of the way, because I know that we're gonna not get to it if we keep going down these amazing questions. So the first one is Sergio, who's actually on the call today. Welcome, Sergio.
Nice.
Asked you in Facebook, what do you think about the idea that we may be in a bubble?
Really great question. And I hear it every so often out there. I think if you're in real estate, and you read articles out there, it's a pretty common question to ask. And we're going to do it. Pablo and I were talking about this, Sergio. We're going to do a whole show really kind of dedicated to this question. It's coming up. Did we say what, in about 2 weeks or so?
2 weeks. Yeah.
2 weeks. All right. So we're going to do a whole show on it. So I'm going to give a little bit of an abbreviated answer on this. But, I know what a bubble looks like, right? I started investing in 2006. Now, clearly I didn't know at that time that I was buying a whole bunch of properties that were then going to go down in value 35%. Didn't matter because I was buying for the long haul, but I know what it feels like. And then the benefit also is having seen that, I also have the data to know what a real bubble looks like. And when you're looking at home values, whether they're going up or whether they're going to go down in future years, there's an indicator, a metric that really helps you figure that out. It's called months of inventory. Months of inventory basically measures the amount of inventory that's in the marketplace, like in a place like Jacksonville, or in a place where you're investing, or you could do this for the entire country. And we see how many houses are in inventory, and we divide it by the number of houses that sold last month. And this is a great way, like any other business out there. If you have a ton of inventory and nothing is selling, you're going to see downward pressure on your prices. And the opposite is true. If you have limited inventory and everything is selling so fast, you have a ton of sales last month, you're going to have pressure to rise your prices. And it's the same way in a real estate market. So when you're thinking about whether or not, just because we've seen home values go up substantially over what the norm is, we've seen that now for 5, 6, 7 years now, the question of whether or not this is a bubble, really, you should go to the data and look at months of inventory. The months of inventory right now is staggeringly low. So in equilibrium markets, between 6 to 7 months of inventory. And when you're in an equilibrium market, that would lead to normal home price appreciation, which is, Pablo?
4.3%.
Nailed it, right? So if you're between 6 and 7, that's what the numbers would indicate to you. If you go way above 7, you would see lower than 4.3% appreciation. The higher you go above 7, that's when you would potentially get to a declining market. In Jacksonville, we've been below 6 months of inventory for as long as I've been tracking this. Since 2014, we started tracking this. Just last month, we had 1.9 months of inventory, the lowest I've ever seen. 1.9 months of inventory, right? So to put it in context here, in 2007, right when the market was about to crash, we had 16,000 houses on the market. Okay. we had 18 months of inventory at that point. If you were an investor at that point and you asked me, do we see a crash happening? Do we see a bubble happening? And I was armed with that data, I would say yes. But that's not what we see today. Right now, we have just over 5,000 houses on the market, a third of the inventory that we had back when there really was a bubble. And we have over 3,000 sales each month, 1.9 months of inventory. So as long as inventory, supply and demand here in Jacksonville, and this is the same for many parts of the country, months of inventory is in the 1s and 2s and 3s and 4s and 5s and 6s. That's not telling me that we're at a bubble. So no, I don't think that we are.
Okay. So difference between just an appreciation market versus bubble is whether or not you are above or below the months of inventory figure that is the norm, the historical norm for the market.
There are a couple other things that we'll show in our show in a couple of weeks that will also support that. Nailed that, right? But that is one indicator that's going to be a great leading metric for you to pay attention to. And for everybody who's in the group, I give an update on this every month. So you're going to stay well informed. I would love for you all to be a part of the Facebook group and to join me in there.
Perfect. And Greg, I don't want to put too much pressure on you, but we got 10 really good questions in the Q&A and one in the chat that I'm going to want to get to. And we got 24 minutes left, right? So use your time wisely. This is an easy one. Verinder Kumar asks, how many rental properties are owned by Greg?
I own over 300.
Done. Guillermo Montes asks, did your monthly rents reduce the same percentage during the 2006 to 2011 drop?
No, they didn't. They were consistent.
So rent stayed consistent, cash flow stayed consistent. It was just that paper value of the home that dropped. You held on to it, and now you're all the way back.
Yep, exactly.
Beautiful.
I'm back, baby.
You're back. Rob Jones asks, in your opinion, how does the probable inflation of the dollar figure into the upcoming appreciation?
Well, the upcoming inflation of the dollar is going to help those who take out debt today more than anything else, because one of the other profit centers for investing in rental properties is a hedge against inflation. And so one of the best things is that when you take out debt in an environment where inflation happens, your debt is set. It's a fixed payment, right? You're paying it back in today's dollars, right? Today, right? But in the future, when you hold on to the loan for 10 years, the value of your dollar actually goes up due to inflation, right? Inflation means that the value of your dollar is higher, right? And if you compare that to what the value of those dollars that you have the debt on is, it gets easier and easier to pay that debt down over time. So inflation is going to be your best friend if you are taking out debt. And so it's going to work out in your favor. As far as the home price appreciation component, generally, home prices over the long haul across the entire country have appreciated somewhere around 3.5% over the long haul. And that's largely tied to what inflation is. So, I mean, you think about the materials that go into a house to build it, all those materials go up in value. And so that's loosely why, home prices are kind of loosely tied to inflation rates over very long spans and talking very macro sense.
Awesome. Listen, Greg, I'm going to address this real quick in the chat. Miguel Angel Sanudo brings up a point that he says he doesn't think that metrics since 2014 are significant enough to make a statement statistically speaking. And I think he's talking about months of inventory, but I think you're talking about months of inventory. You've been tracking it since 2014, but that is a data point that's a statistic much older than 2014 or not.
Oh, 100%. Yeah. If you go back to 2007, like I was mentioning, the months of inventory of a real bubble look like 18 months of inventory or 11 months of inventory, where if you look back at 2006 and 2007 and 2008, those are the months of inventories that you see. And that's why that's that leading indicator. So I appreciate you bringing that up. That's just as far back as JWB has tracked it every single month. We have gone back and tracked it at months at points in time back in 2006. But in 2014, it became, this is something we're going to monitor like a hawk every single month. So that's how we get that.
Perfect. Mark has a question. Would you please comment on the quality of the neighborhood? Thanks.
Yes. Well, we need to set the right expectations for what you're getting into. There is no perfect investment out there anywhere. And rental property investing, especially for positive cash flow, is not going to be a perfect investment either, right? If you think about all the great things that you're getting positive cash flow, which turns this into an asset, not a liability. It means it's paying you every single month. You get to invest in a growth market for a coastal city where population is growing, where we have higher long-term appreciation than other comparable cash flow markets. So being in where positive cash flow in a growth market is a real opportunity. And then, of course, you've got a great team behind you here at JWB. Those are the three components that you need to make a great rental property investment. Now, if you want all of those, you're gonna have to give up on something. And giving up on the quality of the neighborhood is a real discussion, right? If you are going into this and you're thinking that you are going to be your renter in a sense, and you would only want to buy a rental property in a neighborhood that you would want yourself, then this probably isn't going to work for you, right? You have to separate yourself from where you may want to live from where you're creating a wonderful renting environment for somebody else. If you're going to create the best value for that resident, then that's what you're doing in these neighborhoods. So I have no idea if our listeners want to live in this neighborhood or not. It just doesn't matter. It just can't affect it. So we're going to be investing in below middle income neighborhoods, because if we went to average or middle income neighborhoods or above, you wouldn't accomplish the first rule of rental property investing. What's the first rule of rental property investing, Pablo?
Cash flow.
Cash flow. That's why you're investing in assets, not liabilities. So you got to give up on something. You got to give up on this is not going to be an above average or a above middle income neighborhood. It's going to be a below middle income neighborhood. It's going to have below average schools. It's going to have a high percentage of renters in the neighborhoods. Call it 50-50 at best as far as owners and renters. That well could be 60-65% renters, because you need rental demand if you want to have great residents there. So quality of the neighborhood's below middle income, and that's where we love to be.
All right. I want to ask kind of seems like a tough one here, but we're going to go for it here. Miguel Angel Sanudo asks, I guess this coronavirus changes all that we have been taught. Without direct rental assistance, rent may not be able to get paid, and owners face financial crisis of their own not being able to maintain properties and pay their mortgages or property taxes, which is a different situation. What would you say to that, Greg?
Well, this has been a timely topic, of course, since coronavirus broke. And coronavirus absolutely changed the way the world operates. But in terms of rental property investing, the reason why people were investing in rental properties was consistency of an asset class. And rental properties have continued to perform consistently, by and large. And so if you look at rent collection for JWB going into coronavirus, I didn't know what it was going to be, because you bring up some really good points as far as not being able to evict. We've had an eviction moratorium for how many months now, right? It will go on through the end of this year. And I didn't know what to expect. And that's what we openly talked about here on the show and in the group in the beginning. What came to be was that people genuinely want to stay in their homes. Residents understood that rent is not forgiven, that you have to work with your property management team to come up with a really good solution. And so we've done all of that. We've had over 97% rent collection every month since coronavirus time, over 97%. So on the macro sense, it's continued to perform with consistency in the face of having an eviction moratorium, which is an incredible compliment to the property management team at JWB. They're just rock stars. I also want to just shed light on the fact that for those investors that do own rental properties out there where you have a resident that's non-paying and you can't evict, it's tough. It's tough for you. There's not a whole lot that we have been able to do there because, of course, this is an eviction moratorium. And as much as I'm solution-oriented, I can't come up with a solution for that one. We're waiting it out. And so the cool thing is then, if you're investing like me and you're investing for the long haul, right, what's going to happen is that these momentary challenges that have come, if you're investing for a 10 or 20-year cycle, they're going to be fine, right? You're still going to hit your return on investment expectations over the long haul. Even though some of us right now, me included, I have rental properties that I can't evict somebody that it's a painful moment right now. So I want to be sensitive to it. It's a real thing for those who are affected, but by and large, rental properties have performed very consistently for most investors out there.
Greg, haven't seen you answer this question at least a handful of times. I would be remiss not to ask you, for the benefit of the audience, or at least bring up the point that where you are investing in your asset class of home that JWB offers is not the same as every home out there, right? Like the idea that these homes are in a specific neighborhood, that the price point is below market value already, and not a place where somebody would move to in order to upgrade their lifestyle because they came into some money, and where that money would come from is a little bit different. Do you want to talk about that?
Yeah, I think what you're kind of getting to is our qualifications for putting this investment together, from the neighborhood that we're going to choose to put you in and from the qualifications of your residence, right? There are time-tested ways to make sure that your resident is going to be able to afford the rent, right? So like, for example, they need to make at least 3 times the monthly rent. And there's a whole bunch of other qualifications that we could go through. But you bring up another really good point as far as kind of these qualifications. If you're an investor today and you're thinking about what are my risks related to coronavirus, your risks today are a lot lower, because what's happening for the property that the client who's going to buy this one on Sibald, right? Well, this one actually happens to be rented already. So bad example, right? But for the property that another client would purchase today, that is just rented today, right? That resident went through the qualification process as of today. When you think about the huge job losses that happened from coronavirus, it happened in March, April, May, right? Jobs are now being gained back over the economy, right? There's not a whole lot of new job losses that are happening today versus when they were happening in droves back in the day. So your resident today, for your decision today, is going to be qualified based on what their current job status is today. And jobs are growing in this economy overall. So the risk of coronavirus leading to a job loss, which would lead to a lack of payment for your resident, is much lower today than it was in March or April or February or whenever those folks were making that decision. And then, oh, by the way, they still have we still have collected over 97% of rents, even during that time that there was a little bit more risk due to coronavirus.
It's a good point, man. I was teeing you up to talk about the fact that if somebody is renting at a higher price point, they're usually stretching because they got a promotion or whatever to get a bigger house, while the price points that your residents are renting at are not those, right? Like this is like people that are either, I don't want to exaggerate this, right? But this is not a decision of like bigger home, lower home. This is like no home or home. And that is the last bit of thing that people don't spend money on.
Exactly. Right. If we're thinking about it, simply, so 3 times the monthly rent, if the property value or the rent value is $1,000 a month, they need to make $3,000 a month, right? That's $36,000 for the year. If you have to think about who's more susceptible to not being able to pay the rent, the person who needs to make, a $2,500 rent payment versus a $1,000 rent payment is more susceptible to a loss of income if you have to make $2,500 than $1,000. You would be more susceptible to job losses if you have some of those higher paying jobs that, may not have been retained during coronavirus time. So your point's very valid. We choose this segment because it's risk mitigation across a ton of different levels.
There you go. All right, let's get back to the Q&As. Rob Jones asks, what are the percentages of maintenance costs for?
What are the percentages of maintenance costs? So we estimate 9% out of the gross monthly rents. So Paulo, if you want to bring up the evaluation, sometimes folks are confused when I use these percentages. Why don't we break down what that number really means?
Oops, I'm just sharing the wrong thing here. These are my notes.
There we go. You can see your email. Let's see who you were talking to, buddy.
Here we go. Just some Nigerian prince that promised to deposit $20,000 in my bank account if I did something.
That's funny. So, all right, change that back to. My Apple Watch is talking to me now too. We're all sorts of technology going crazy here.
Yeah.
All right, so we've got 9% here. Well, what does that really mean in dollars? If you go over to the left there, For that, go over to the rents. All right. So the lease, this one's actually rented already. This resident's been in here since 2012, by the way. That's a long time.
That's a resident. That's not a tenant. That's a resident.
That's a resident. So if we take, and everybody can use their calculators that they got, right? I'm just using my phone right here. So 1,050, this is obviously built for you into the spreadsheet somewhere else, but I'm just going to keep it here. So 1,050 times 12 gives me $12,600 in rent annually. If you take 0.09, 9% of that, we expect to spend $1,134 in maintenance cost per year for this property.
There you go.
There you go.
Mark had a question that's actually pretty timely. He was asking, does this property currently have a tenant in it? And if so, how long is the lease? So yeah, it does have a tenant in it. How long is the lease in here?
It is, I was putting the numbers in here. It's coming up for renewal in August of 2021. So you've got another year of renewal here. They've been in the home since 2012, which if somebody's been in your home since 2012, they call it your home, their home, right? That's a great sign.
Great. Rob Jones asks, what are the percentages of maintenance costs for new? Oh, okay. So I guess he was clarifying, right? Like new build on sewer, new build with septic, rehab on sewer, rehab on a septic. Like, I guess he was saying, like, what are the baseline percentages that you use for that? Do you have that off the top of your head?
Yeah, absolutely. So for new construction homes, whether it's septic or sewer, doesn't matter. We haven't seen a difference. You're going to be at 4% for your maintenance costs per year. For your renovations on sewer, you're going to be at 6% for your maintenance cost expectations per year. For renovations on septic, it'll be 9%.
Boom, hard hitting. Sergio asks, interest expense paid on a rental property is tax deductible, right? So that would be a profit center, right? Usually when I hear you reference tax savings, you're referring to depreciation, but I don't recall you mentioning interest. Am I right?
You are right on all accounts, Sergio. But that profit center is actually accounted for in the numbers. So what Sergio is talking about is it's not just depreciation that is a tax write-off for you. You get to write off a whole lot of stuff, right? You get to write off your property management fees. You get to write off your interest expense, like he's talking about, any maintenance costs, your property taxes, your insurance costs. Even when you want to come down and visit Jacksonville or visit, Disney when it's opened up like it normally is and all that good stuff. You want to take a trip down to Florida on your vacation. You want to come down and check on your property manager and your properties. Now you can, I should say you should check with your accountant. You should make sure that you fully do what you need to do to qualify for a tax deduction there. But there have been investors that have done that and have received a tax deduction. I don't want to get in trouble there. You saw what I did there, right?
I saw what you did there. I saw what you did there. But I've heard people talk about that, right? Like the idea that if you own a house in Florida, now you can expense your trip to Florida to go.
Got to make sure you do it by the letter of the law, right? Do what you need to do. And then yes, that tax deduction is there because you're managing your investment. So all of that is there. It's actually calculated into our returns because what we're doing is we're showing the value of the write-off from depreciation as far as taking away from what your income earned from your net rental income would be. So the way to get the net rental income is to take all of those expenses away and those basically offset. And that's really what the tax savings is. It's not paying taxes today on what that income would have been. And that depreciation write-off offsets the net gain there. So for any of you following at home, there's a little bit of accounting there, but just know that that's a great question from Sergio. He's absolutely right. You can get these other deductions and then we factor that into your returns as well.
All right. So Candice Morrow has a question here that I think it's a little bit, it may throw you off a little, but I'm going to ask it because Candice, I'll be honest with you, right? I invested with JWB about, how long was it? Like 8 years ago, 7 years ago, something like that. And when it came time to renew my investment, it was coming up on the last election. And I totally overthought it. And I still kick myself about it because of it, right? So Candice Morrow asks, and I want you to explain why this is, Greg, but Candice Morrow asks, any comments on how the upcoming election results could affect the real estate market?
Yes, absolutely. And then we should clarify, Pablo, what you were talking about is renewing your private lending investment.
Correct.
So a little bit different than turnkey. Private lending is a little bit more you have the ability to kind of get in and get out. It's a little bit more transactional and all that good stuff. But yeah, I'm still kicking you for making that decision. And
Man, whatever. Go on.
Go on. I don't think I'll let you live that one down for quite a while.
Yeah.
So all politics aside, there are things in the tax code and then the tax plans that you all should pay attention to when it comes to real estate. There have been rumblings about the 1031 being changed according to Biden's tax plan. What I'm hearing from other podcasts and other people in the know is that would be a major shift, and that has been talked about before by presidential candidates, and then it hasn't really happened. So the general feel that I have heard loosely out there is that that is unlikely to go forward, but take that with a grain of salt, because who knows, right? That would be something that would affect us as real estate investors greatly. A 1031 exchange is a great way to get tax deferred gains on your properties and being able to reinvest those. There's other things that really, I don't want it to become political at all. So I'm going to sidestep it a little bit there.
Yeah.
But I would really encourage everybody to review the tax plans for both, and to see specifically for you as an entrepreneur, you as a business owner, you as an employee, how would this affect you going forward?
It sounds great to answer it in a general fashion. It sounds then that the one thing that it could affect out of the 5 profit centers is the tax savings if they change something that's based on real estate investing. But the fundamentals of this asset class are not really beholden to elections, which is what I had wrong.
That's true. Now, crazy things happen during election years, right? I mean, there's just a general sense of like pause on a lot of stuff during election years. And you don't know what's going to happen in the stock market, right? You don't know what the relationship is going to be. The great thing about what we're investing is I don't care about election years when it comes to making decisions on buy and hold properties, because I buy and hold based on fundamentals, and I buy and hold for full market cycles. Is what's going to happen in this election going to change the trajectory of that 4.3% average home price appreciation rate since 1991? No. Right? So I keep the long term. I look at the fundamentals. I make decisions based on positive cash flow and those things that we have talked about. And then I plan to hold on, and I expect that I'm going to see historically accurate home price appreciation in the future. None of that matters to me as far as who my president is next year. It doesn't make a difference specifically on the rental property investing.
Yeah. And also specifically in Jacksonville, where we have this like mix of economy and the industry that's here is very, very stable, and the different Fortune 500 companies, right? Like that's really not going to change at all. Yeah. Greg, we have like 5 more questions and 2 minutes till 1:30. How are you doing on time, buddy? Can you stick around?
Of course.
Always over delivering, my friend. Let's go quickly. Brad Cirero asks, what % do you guys hit for list price to appraised price being accurate?
We always sell at appraised price. The appraisal value has to match the sales price for us. We're selling to you at market value. So there you go.
Cool. 100%, buddy. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
That's right. Marilyn asks, what is the current interest rate for investment properties?
4%. On your property evaluations, when you get the investor toolkit, you'll see 4% there. That's incredibly low. You are never going to see these types of interest rates, especially as this economy eventually does recover here. You're just not going to see it. I've never seen it in all my years of investing. So look at it, take advantage.
Love it. Mike Foster, are monthly expenses extracted from rental income before the amount remaining is given to the investor each month? Or rather, is the investor routinely sending money to the property management team for various expenses?
Could you repeat the beginning of that question? I just want to make sure. Was he asking about property taxes?
He is asking monthly expenses.
Monthly expenses. Okay, great. So that's a great question. So what happens is we build this so that this is a passive income stream for you. As a passive investor, if you're living in California, New York, or Atlanta, like I know Mike lives, you're not here in Jacksonville, the last thing you want is to be involved in every single nickel and diming decision of like a $5 expense here, a $10 expense, or a $50 expense. You want to make sure that you have insight into it and visibility into it, but you want to trust us to manage it. But then there's also a threshold. So the $400 threshold is that threshold for us. So anything under $400, JWB is given the authority on behalf of you as the client to go ahead and handle the situation and make the best decision for you. You get to see all the bills, all the invoices, everything is there in your monthly statement for you. And you can log on at any time to see your portal to see real up-to-date information there. Anything above $400 is when we need to go to you and get your approval. And what we do is we don't just send you the invoice, we come to you with a solution in mind. If it's something that's a little bit more hairy, we're not going to come to you and just say, here's what do you want to, here's the cost. What do you want to do? We're going to say, here's the cost. This is how it factors into your overall return on investment. And here is our recommendation, or here are our two recommendations. Which would you like?
Excellent. Excellent. And Mike, I think you know this, right? But that portal that you just described, I just got my first view of that return on investment interactive portal. And it's pretty awesome that you guys have that tool that's just as like dashboard that shows everything at all times, unlike anybody else in the industry. Teaser, we're probably going to do a show about it. All right, here we go. Next question. And by the way, this put a smile on my face the moment I saw this populate. Jeff Baker writes, touchdown maker here again. Do you have new construction inventory now, or is there a lead time to build?
We do have new construction inventory, Jeff. Just reach out to my team. You can schedule a time at chatwithjwb.com. We'll be happy to bring you through.
All right. And more importantly, I want to hit on that, the fact that you guys never offer properties that have some kind of a lead time, right? It's just like from close to you're done, cash flow positive on day one, unlike all other turnkey rental income property.
Yeah. So we're talking about two separate times of lead time though. I think, let me just kind of clarify what Pablo's talking about is your cash flow positive from day one with JWB, meaning when you close, you're going to have a resident in place, right? You're not going to have vacancy costs right off the bat. You're going to be cash flow positive from day one, which is really different than if you're investing any other way other than a turnkey property with JWB, right? If you're an investor yourself, you got to buy the property yourself, which takes a lot of your time. When you close, you got to renovate it yourself. Then you got to go and find the resident yourself or hire a property manager. And so you're many, many months after you close to getting that first positive cash flow for you. So you avoid all of that when you invest with JWB, right? Now, I think what the touchdown maker was asking about was like lead time from putting it under contract to actually closing. Because in the general space right now, many turnkey companies out there are struggling to source inventory. So what they do is they put it under contract to sell to, let's say, to the touchdown maker, but it might not be renovated yet, or it might not be built yet. It might be 3 to 9 months away from actual closing. And so the touchdown maker wouldn't get the touchdown of positive cash flow for a long time. You don't have to worry about that with JWB. We do start to market our homes, let's say kind of 2 weeks, 4 weeks, maybe, 6 weeks. It's not going to affect your actual closing date, which is how we look at it. But if we can start to market it a couple of weeks before the finishing touches are done on a home, that's not uncommon. In fact, this home, not this home on Sibald, the home that I'm going to be showing next week, actually, I've been looking at. That's the one that is still a couple of weeks out from being completed. And so you guys will see one in action.
So Jeff Maker, touchdown maker, does not have to wait to cross the goal line of positive cash flow when he closes on his property. Am I right? Am I right?
Nailed it.
So Rob Jones has a couple of good recommendations here on YouTube and whatnot to look for sources that give information on the election and the tax plans. I don't really want to get into that now, but Jeff, if you, God, I just forgot the name. Rob, if you could put that in the chat, that would be great, and share that with people. I'm going to go into the chat real quick. Denise has a follow-up question, piggybacking on the question of the $400 maintenance reserve. She read in her lease that residents are charged $100 when they call with a work order for something broken. I've never heard of a tenant paying for repairs. Can you elaborate?
Yes, absolutely. So one of the things that we do to make sure that we're taking care of the resident, but at the same time that they're responsible for their homes, is that when a resident calls in and has a maintenance issue, they are charged the first $100 on that repair issue. And then what we do after the fact is we're going to go ahead and get that taken care of. Now, what we do with residents is they're going to be responsible for large charges that result from that, whatever maintenance work. Like if it's a $1,000 bill, that resident's going to be responsible for it. But for many times, if it's something that's just over the $100 mark, then they're not going to be charged for that. And so what we have realized is that residents and paying this kind of what we call this resident rent collection or tenant, it's called resident expense recovery for us. It's hard to do that after the fact. And it also doesn't encourage residents to take care of homes the right way. And so this $100 charge has been a happy medium for all of us. It's significantly reduced maintenance costs for our owners, and it's fully described to residents when they come on board, and they're made aware. So it's kind of a happy medium.
Awesome. Awesome. So Rick Morgan has a great question here because he feels that he needs to move more into real estate, and he wants you to talk about investing in stocks and real estate. Do you do both, and how do you think about it?
I only invest in the stock market when I have to. Funny thing, it's a little bit ironic, but at JWB, our company 401k plan does not allow you to invest in real estate. It's very difficult to find one that does. And so for the company 401k plan here at JWB, I have money that I have to put in the stock market. Now, the cool thing is that you can actually take a loan against your 401k plan many times. So I have taken a loan against my company 401k plan here, and then I invested in real estate or private lending or syndications or whatnot. But my personal idea on this is that I understand and believe in diversification. I don't think you put all of your eggs in one basket, but with real estate, you can diversify within real estate and get similar diversification. So for me, I look at diversifying. Of course, I have the business, I have my rental properties, but I also have a significant amount in private lending and syndications and whatnot. So that's my diversification. I just can't stomach. I just don't understand how like the bond investment beats a rental property investment in any way, shape, or form. I just don't get it. And so most people in their stock portfolio, they think of the bond as the consistent producer for them. So for my consistent producer, I just don't see how bonds make sense. And so I don't do that. And I do as little as possible as I can elsewhere. But that's just me.
Yeah. I think that's a good call, man. Listen, at the end of the day, there is you look at a couple of different buckets based on what your risk profile is and what you're into. I know that I have a certain amount of money that I use for gambling in the stock market, right? And I put all of that in Peloton right around like February 28th, and it's been incredible. But I also very, very much believe in having most of your money in, safe things that are going to be predictable. And my experience on this show so far has been that this is that asset class for me as well. And as you know, Greg, I'm working on getting
got something brewing there, huh?
Hard back into it. Yep, absolutely, man. So Sam Thike or Thicky, San Thike Thicky. Sorry, San. I know I'm butchering your name and I feel terrible. If you have reached 10 conventional loans, how can I acquire more property? Private money loan? Is interest rate too high? Any feedback there?
Yeah, it's generally pretty difficult to get a decent rate on a loan if you have 10 finance properties. And the source of this is because Fannie Mae guidelines only allow conventional financing for borrowers who have 10 or less properties on their credit. So that's where this comes from. So you won't be able to get the best rates out there once you're over 10, but there are so many strategies to help you out with this. I would highly encourage you to talk to my team. Like, here's one strategy, right? This 10 finance property limit. Many people don't think about this in advance, but between you and your spouse, there's really actually 20 loan opportunities there, 10 for each, because you both own them jointly, and then you actually have 20 spots, right? So there's one. If we can talk to you early and kind of plan, and this is what we do in our buying plan conversations before we actually start to sell you a property, start to plan this out, you can walk into this and double the amount of properties that you can get conventionally financed for. There's a lot of other ideas that can help you as well. And then in a worst case scenario, we work with lenders that have additional loan products that cater to maybe that 11th property or that 12th property. They're not as great as far as terms because you're never going to get that 4% loan unless you stick to Fannie and Freddie, but they're pretty good. They're pretty close. So I would highly encourage you to reach out to my team, have any of those conversations, and most of the time we can help you get in there If you go down the private money route or the hard money route, most of the time it's not going to work for a rental property investor unless you have a way to refinance that pretty quickly, just because you're not going to get positive cash flow if you're paying 10, 12, 14% rates.
Got it. Stephen Block, AKA Steve B, who is very active in our Facebook group, asks, when does it make sense to sell a fully owned property in order to buy with financing 2 more or 10 more or whatever, right? Like at what point would you liquidate a property that you own outright in order to leverage that for multiple properties?
Man, so many things to unpack here as far as, needing to understand a little bit more, Steve. If you're like me and you are planning on holding on for full market cycles and beyond, there's so many ways to access that capital and still retain the asset, right? So like if your goal is to acquire and grow your portfolio, then it doesn't make much sense to me to sell when there's alternatives where you could still keep your asset and still grow your portfolio. Like for example, if you own a property that's free and clear, interest rates are incredibly low right now. You could take a loan out against that property. You could get 75% of the value, and then you could use that maybe for 2 or 3 down payments on your next rental property. So you could keep that first asset, get in at historically low interest rates at 4%, you'll still be positive cash flow, and then you just grew your portfolio by 2 or 3 assets in addition to that. Lots of our clients are doing that right now, especially those who purchased in 2012, 2013, 2014. You have huge equity spreads, and your ability to refinance now is a huge opportunity for you to access that capital, turn into another great investment or 2 or 3. Now, if you're in a different state of life and a different time horizon, and maybe you're at retirement and you need that cash flow tomorrow, right? Maybe it doesn't make sense to purchase again, right? Maybe it's maximizing your positive cash flow. So I kind of gave you 2 ends of the extreme, depending on where you are in your growth needs at the moment. And yeah, Steve, I would just encourage you to reach out to my team and we can just really kind of diagnose what we think would be the best for you.
That's a gold nugget right there. And Steve, if I'm not wrong, Steve's an investor with JWB?
I think so. I see Steve active in the group so much that I want to believe you. There he is. All right. Yes, he is. Okay, Steve, reach out to your portfolio manager.
Yeah.
We'll help you out. That's a great question. Your portfolio manager is there to have that conversation whenever you need it. And we definitely have that conversation on a monthly basis or in an annual planning conversation. So it sounds like it's about time for one of those, Steve. We'll help you out.
Yeah. And I just wanted to, I wanted to call that out because of the portfolio manager that JWB has, right? Like, I think that is a major differentiator. If you're new here and you haven't invested with JWB, you are awarded a portfolio manager that is your point of contact that allows you to, keeps you in line with your financial plan and is the person that you can ask any kind of question you have. You have that concierge service with JWB. And man, I feel bad, right? But Miguel Angel Sanudo had a couple of questions in here, and I realized that because he's in Europe, the timestamp for the Q&A puts him all the way at the bottom. So it says that he's asking at 8:21 p.m. and 9:43 p.m. But I think you can answer these pretty quickly, Greg. Miguel Angel asks, are maintenance costs not a lottery in the long term?
Are maintenance costs not a lottery? So I think what he's asking is, are they highly variable?
Yeah.
Right? No, they're not.
Okay. There you go.
Over time, you're going to see them come back down to the norm. So what happens is, just so you know really kind of how it works for maintenance costs, when your home is rented, your maintenance costs are much lower than we tell you to expect because you have a resident living in there. So you're sort of kind of building up a surplus because you're not spending nearly as much as what we estimate, right? And then what happens is your resident moves out, call it in JWB's land, it's every 54 months on average. Right, so a little bit over 4 years. And when that happens, that's where you have a little bit of a punch to the gut. You have a couple $1,000s that you have to pay to get back into rental shape. And so you kind of throw back, hopefully you built up a nice surplus of low maintenance costs until you get there. And then you're giving some of the house's money back in that. And then, the same kind of cycle happens. That's why we focus on long-term residence days as much as we do. So no, those maintenance numbers have been over a large portfolio over a long period of time. And if you are investing within your own portfolio, you're going to see that it's going to come back to the norm the longer you invest and the more properties that you own.
Yeah. So Mark sent us a private message in the chat that Mark, if it's okay, I'm gonna share it with everybody because I think it's normal. He's not investing in JWB. He had the same question, so he wanted to know who to reach out to there. And I just, we don't always promote this, but the chatwithjwb.com, that is the place that you go. You can set a calendar appointment with JWB's team and their sales team. They're all very, very knowledgeable. If you have a specific question for you, right? Like we normally tell people if they want the next step to go to jwbwebclass.com because it's less intrusive. But if you really, really want to talk to someone, the JWB sales process is 95% informative. It's really all just like, does this fit for you? So if you just want to take that call, get on the call with the mics, ask them that question or any specific question that you have for your rental portfolio, that is the place to go. It's chatwithjwb.com. I'll put it here in the chat as well. So Dominic Albano has an awesome question here that I'm gonna bring up because we have a name for this. But Dominic Albano asks, can I purchase more than one property right off the start? Do you use cost segregation for new construction property for high income earners?
Oh, okay. Well, let's take the first one. Do we allow that, Pablo? What do we call that?
Yeah, we call it bundles, and we've actually had a rash of bundles happening over the last couple of weeks. So yeah, Dominic, we definitely allow that.
We were on a streak. I don't know if the streak's still here. It was 9 consecutive clients purchased a bundle of properties, more than one property. That was a fun streak. So it's very common, and it really goes in line with the bigger picture goals. I've been talking to Pablo about him buying his first rental property. We were talking about this morning on the run, and we talked about how I wanted to make sure that it was more than just a one and done situation for Pablo, for him and his wife, and make sure that their family goals are aligned, because it doesn't make much sense to get into rental properties if all you want is one property. Because the reason that you're coming to rental properties is consistency. That's probably not what you're getting in your other asset classes. If you only have one rental property for a long period of time, it's not going to be consistent. It's going to be up and down, right? Because you're going to have a few good years, maybe 4 good years where your resident's in there. And then if you only have one rental property, then when they leave, it's not going to be a great year for you. And so the key is getting to 3 rental properties. Because if you have 3 rental properties or more, right, you have 2 that are overperforming at any point in time when the resident's in place. You always have one that has an issue. And what you see over time, and this is going to be a great thing to show for that client demo, what you see is consistency across the entire portfolio because you're diversified. And so 3 rental properties goes a long way to do that. And JWB actually incentivizes our clients who do that. What we do is we actually do a, oh my goodness, I forgot what we call it. It's $500 off the tenant placement fee. I can't remember what we call it, but we do $500 off the tenant placement fee when clients purchase 3 or more at one time. And so it works out in everybody's benefit.
Is it the Super Bundle Super Saver? Is that what it's called?
That's it. Thank you. I forgot that.
Just made that up. I forgot to ask Miguel Angel's other follow-up question. Do you have another way to invest with JWB outside of rental income properties?
We do. It's called private lending. This is a situation where basically you can become a lender to JWB. JWB uses those funds for projects like this one on Sibald or a new construction home that we build. And then you, in effect, become the bank, and you have a mortgage, you have security in that investment, and we pay a 10% interest rate. Difference between private lending and owning rental properties, though. Private lending, you are earning that 10% interest rate, but you don't get to enjoy the upside of a growth market. It's just 10%. If you're investing in rental properties, you get all of the profit centers, including home price appreciation. And when you invest for the long haul and you factor in all of the profit centers, you have a higher expected rate of return for actually owning the rental properties. But both are really popular with our clients.
All right, Greg, we still got more questions, man. Are you still good?
I gotta, man, this has been the longest one.
This is amazing, man.
What an honor. What a blessing. Yeah. I truthfully, I didn't plan for this long. So what I would say is let's take maybe one more, and then for any other ones, let's just ask our folks to join the group. And my commitment to you is if you go in the group and you ask this question, just like there have been a few other questions like Sergio's that we asked earlier, I'm going to be there and I'm going to answer it for you there. So I appreciate all of you with all of these questions. I didn't plan to be here for that long. I've got a call that I got to jump on soon.
All right, so let's pick a good one. Can you take a loan off a property bought from your retirement account? By Rick Morgan.
Can you take a loan off a property bought in your retirement account? Probably not. I mean, the solution-oriented part of my brain says, yes, there's always a creative way to do it. But in reality, you're not going to be able to get lending on your retirement account. Actually, never mind. Let me change the game there. There is non-recourse lending. Okay. So you can refinance a non-recourse loan. So there is non-recourse lending for it. What you can't do is you can't get one of these really low conventional rate loans that I'm talking about for a property that's in a retirement account. So just have to change the expectations on terms, interest rates, all that good stuff to be in the non-recourse loan environment. And then yes, you can do that. You can refinance a property, use that to acquire other rental properties in your retirement account. So that's a possibility. Can't do it to get unqualified money, meaning money outside of your retirement account, unless you, of course, pay the distributions. Answer is I could probably come up with a way to do anything, but let's keep it simple. Answer is yes if you keep it in your retirement accounts, no if you're trying to get conventional rates.
Man, what a call, Greg. We still have 34 people with us. I wish we could stay forever. I also have a 2:00 call, so I was kind of freaking out, but I didn't want to leave you hanging. Listen, I'm gonna take note of these questions here, right? I'm gonna copy and paste them and kind of sort through them later on. If there's something that needs us getting back to you, we will. But I do encourage that you follow Greg's advice. Join the Facebook group. You know, I put the link in the chat there where we interact on a daily basis. Greg goes in there live. You can ask all the other investors in there. They're all very, very knowledgeable, a ton of JWB clients in there and a ton of Jacksonville residents in there that can help you out. I want to thank you all. We do not take it lightly that you spent an hour and 20 minutes with us, 33 people right now still on a Thursday, middle of the day. It's really great to be a part of this and great to have to add value to your life and answer your questions. On Tuesday, we have Joe Dela Cruz coming in, who was a W-2 employee. He was an engineer. He got in with JWB in 2011, 2012, something like that, bought his first property, and 7 years later, he's been able to leverage his experience at JWB to quit his job, start his own real estate company. He's a realtor and he's a freelance engineer. So he's been able to fire his boss. It's a great story. You're going to get to ask him a bunch of tactical questions on how he was able to do that. So I encourage you to join us. And apart from that, I'll leave it to you, Greg, to say goodbye to our friends.
You know, just what an honor, what a pleasure. Appreciate the time for everybody and really appreciate the community that we have. And that's why, you know, in the group, I'm going to answer those questions, but you're going to hear a lot of other really savvy investors chime in as well. And I think that's just it's a fun thing to be a part of. So would encourage you to be there. And then I'm just excited about Tuesday for the show. I actually won't be there on Tuesday. I won't be there Tuesday next week, but I know my boy Pablo is going to hold it down. I'm going to be in business planning all next week. So we're excited to plan for the next few years, but you guys are going to love the show with Pablo and Joe.
See you next week, everybody. See you on the Facebook group, everybody. Bye-bye.